Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Just a reminder that this week there will only be 3 episodes of Market Update rather than the usual 5 to 6. That said though, we have a big week ahead, so let's jump in. First up, US stocks have lagged behind their global peers by the widest margin in more than 3 decades, as US President Donald Trump's trade reset fuels an investor retreat from American assets. These 2 graphs from UK-based The Financial Times illustrate this well. The MSCI USA index, a broad measure of US equities, tumbled 11% over the first 16 weeks of the year. In sharp contrast, the MSCI All World ex-US index rose 4% in dollar terms over the same period, marking the largest gap in performance since 1993. Then, like now, US investors were drawn to foreign stocks amid trade liberalization abroad and domestic economic unease. The sharp divergence highlights growing fears that Trump's aggressive trade policies will inflict greater damage on the US economy, in the short term at least, suppressing growth and driving inflation higher, compared to the rest of the world. In Europe especially, Washington's at least perceived retreat from global leadership has spurred plans for higher government spending, particularly on defense, boosting local equity markets. Quote, "A large part of this underperformance is the repricing of US assets due to increased policy uncertainty and the stagflationary shock from tariffs," end quote, said Samir Gul, head of emerging markets at APAC Research at Deutsche Bank. A weakening dollar has further widened the gap, with the greenback down 8% this year against a basket of major currencies, lifting returns on overseas markets in dollar terms. At the start of the year, investors bet US stocks would maintain their edge, buoyed by Trump's corporate tax cuts. But sentiment shifted sharply after the president launched a far more aggressive trade war than expected. Why the market was surprised that the US president did exactly what he promised to do on the campaign trail remains unclear. The S&P 500 plunged as much as 12% in the week following Trump's so-called Liberation Day tariff announcement on the 2nd of April, although partial tariff reversals and suspensions have helped the index recover some losses. It continues to trail major international benchmarks. In Europe, defence stocks such as Germany's Rheinmetall, Italy's Leonardo, and UK's Rolls-Royce have outperformed, lifted by plans to boost military spending and reduce reliance on US security guarantees. Germany's DAX index has surged over 20% in dollar terms this year, while France's CAC 40 is up around 12%. Quote, "Capital is flowing towards Europe, buoyed by confidence in strong institutions, governance, and equity markets, which typically trade at discounts relative to their US counterparts," end quote, said Lewis Grant, senior portfolio manager for global equities at Federated Hermes, speaking to the FT. Meanwhile, Hong Kong's Hang Seng Index has gained 10%, powered by Chinese technology stocks, especially after startup DeepSeek unveiled AI models said to match US rivals at a fraction of the cost. Next up, we move to Asia. South Korea's economy contracted for the first quarter of 2025, with political instability and escalating US tariffs undermining growth and dampening consumer sentiment. The country's gross domestic product, GDP, declined by 0.2% quarter-on-quarter and 0.1% year-on-year, according to Bank of Korea data released over the weekend, just as trade talks with the US began. The contraction reflects a convergence of domestic and external pressures. At home, consumer spending dropped 0.1% as uncertainty mounted over President Yoon Suk-yeol's failed attempt to impose martial law in December, a move that led to his dismissal and snap presidential election scheduled for the 3rd of June. Investment also declined, with construction and facility investment dropping 3.2% and 2.1% respectively. Internationally, South Korea's export-reliant economy has been hit hard by President Donald Trump's trade measures. A 25% US tariff on steel imports from South Korea, introduced in March, has now been followed by steep duties on automobiles and vehicle parts, sectors that together make up about a third of South Korean exports to the US. A general 10% tariff on all imports from South Korea has also taken effect. Korea's finance and industry ministers are in Washington to negotiate a resolution, with the latter vowing to seek swift relief from vehicle-related duties. Acting President Han Duck-seo has emphasized diplomacy over retaliation, citing South Korea's historical ties with the US and advocating for a win-win solution. We covered this last week. However, the economic toll is already visible. South Korean exports fell 5.2% in the first 20 days of April, with US-bound shipments down 14.3%, and those to China falling 3.4%. The IMF has slashed South Korea's 2025 growth forecast from 2% to 1%. The Bank of Korea has warned of mounting downside risks. Amid a 16-year low for the currency, the won, and soaring household debt, the Bank of Korea is expected to cut interest rates in the coming quarters. A supplementary 12 trillion won, $8.4 billion budget is being prepared, but analysts warn that deeper structural support may be needed to weather the combined shocks of political crisis and global trade turbulence. We are certainly living in interesting times. This world is going through a massive transformation that we have not seen for decades. If you want to be on top of the most up-to-date analysis on these movements as we live them, make sure you're subscribed to Market Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Next up, UK consumer confidence plunged in April to its lowest level in over a year, as escalating concerns once again over the US president's global trade reset and a barrage of cost increases weighed heavily on household sentiment. According to research group GfK, its consumer confidence index dropped 4 points to minus 23, the weakest reading since November 2023, when households were grappling with surging mortgage and rental costs. Neil Bellamy, Consumer Insights Director at GfK, cited multiple April cost increases in energy, water, telecoms, stamp duty, council tax, and road charges for the domestic fall. Compounding these pressures were dire warnings that Trump's 10% tariffs on UK products could ignite renewed inflation and further dampen economic growth. While the full inflationary effect of the tariffs remains uncertain, Bank of England policymakers have warned they could derail the UK's fragile recovery. Private sector activity also shrunk in April at its fastest pace in more than 2 years, according to the S&P Global Flash UK PMI Composite Output Index, which we covered a few days ago. Other measures of confidence, including indices from the British Retail Consortium and S&P Global, confirmed the downturn, suggesting that household spending, a key driver of UK growth, may weaken further. Mariam Baluch, economist at S&P Global Market Intelligence, noted that consumers' heightened concerns over global trade disruptions and personal finances are likely to trigger a more cautious approach to spending and saving in the coming months. The shift is particularly concerning given the green shoots seen earlier this year. Official data showed the economy grew by 0.5% in February, ahead of Bank of England forecasts. Consumer services sectors like bars and restaurants also saw robust growth, and inflation fell more than expected to 2.6% in March, while wage growth remained strong. Many economists had anticipated a rebound in household consumption, forecasting growth of 1.3% for 2025, more than double 2024's 0.6%. However, these hopes have dimmed. Consensus Economics now projects just 0.9% growth for the year. At the same time, a curious paradox has emerged. Britons are hoarding more cash even as they spend less of it. According to Bank of England data published in recent days, a record £86 billion in banknotes is now in circulation, the largest increase since the pandemic. Yet cash accounts for just 12% of all payments, a reflection of the country's increasingly digital economy. The bank attributes this phenomenon to a growing preference for cash as a store of value during uncertain times. With cyber risks rising and physical cash points disappearing, many find comfort in keeping cash on hand. Others are driven by more pragmatic motives. The hidden cash economy remains alive and well, as paying in cash often helps consumers and small businesses avoid VAT, value-added tax obligations, or banking fees. Ultimately, the collision of geopolitical turmoil, rising living costs, and a faltering recovery threatens to drag down UK household spending, just as fragile economic momentum had just begun to build. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Monday, have a productive week, and I will see you in a few days.